Nowadays, there are numerous investment opportunities available to Filipinos that offer ads on social media. Our young generations live life in the fast lane and have a high tolerance for many of the risks involved in investing. For such individuals, it's easier for them to decide to invest a good portion of their money in high-risk securities or to play the numbers and invest directly in individual stocks offered by companies listed in the Philippine Stock Exchange. But how about those beginner investors who are not great at managing risk? To get better results, you need to learn how to manage risk successfully. There are 5 primary ways to manage investment risk. First is follow the trend. Trend following or trend trading is a trading strategy according to which one should buy an asset when its price trend goes up, and sell when its trend goes down, expecting price movements to continue. When the price is moving in one overall direction, such as up or down, that is called a trend. It says to make the trend your friend until it ends. One way to manage investment risk is to commit to only buying stocks or exchange-traded funds, ETFs, that are in an uptrend and to sell them once they fluctuate their trendline support. You can draw your trend lines by connecting a series of higher lows on a chart, or you can use a moving average like the 50-day or 200-day to act as support. If the price breaks that support level by a predetermined amount, you sell. The second way to manage investment risk is rebalancing. Rebalancing is the process of realigning the weightings of a portfolio of assets. Rebalancing involves periodically buying or selling assets in a portfolio to maintain an original or desired level of asset allocation or risk. For example, say an original target asset allocation was 50% stocks and 50% bonds. If the stocks performed well during the period, it could have increased the stock weighting of the portfolio to 70%. The investor may then decide to sell some stocks and buy bonds to get the portfolio back to the original target allocation of 50-50. Position sizing refers to the number of units invested in a particular security by an investor or trader. An investor's account size and risk tolerance should be taken into account when determining appropriate position sizing. Another way to play defense is to simply limit your exposure. If a given investment is riskier than others, you can choose not to invest in it or to invest only a small amount of your capital. Many investors use this type of approach to gain exposure to riskier sectors like biotechnology or small-cap stocks. For example, a 50% loss on a P2000 investment hurts a lot less than it would on a P20,000 investment. The easiest way to lower your stock market risk is to shift some of your capital to cash. The fourth way to manage investment risk is a stop-loss order. It is an order placed with a broker to buy or sell a security when it reaches a certain price. Stop-loss orders are designed to limit an investor's loss on a position in a security and are different from stop-limit orders. When a stock falls below the stop price, the order becomes a market order and executes at the next available price. For example, a trader may buy a stock and place a stop-loss order 10% below the purchase price. Should the stock drop, the stop-loss order would be activated, and the stock would be sold as a market order. You can place a stop-loss order with your broker will automatically sell out all or part of your position in a given stock or ETF. If it falls below a preset price point. Of course, the trick is to set the price low enough that you won't get stopped out on a routine pullback, but high enough that you will limit your capital loss. Placing a stop-loss order is one way to limit the damage to your portfolio and force yourself to follow strict defensive discipline. In the end, moving or ignoring stop-loss levels almost always results in greater losses. The first exit is the best. The fifth way to manage investment risk is diversification. It is a risk management strategy that mixes a variety of investments within a portfolio. A diversified portfolio contains a mix of distinct asset types and investment vehicles that attempt to limit exposure to any single asset or risk. The rationale behind this technique is that a portfolio constructed of different kinds of assets will, on average, yield higher long-term returns and lower the risk of any individual holding or security. The idea behind investment diversification is to buy asset classes or sectors that are not correlated. That means that if one goes up, the other is probably going down. Diversification has been more difficult to achieve over the past few years as many asset classes have become highly correlated. Even stocks and bonds have been moving in the same direction more often than in the past. Diversification is a good strategy to limit your risk, but it only works if the assets you buy are uncorrelated. Make sure you look at relatively recent performance rather than relying on historical relationships that may no longer be working.